Every year, millions of beginners enter the stock market hoping to make money, but most of them end up losing it. Not because the market is impossible to beat, but because they unknowingly repeat the same critical mistake. Even some of the greatest investors in history warn about these traps. If you're new to investing, avoiding these 5 beginner mistakes could save you from losing thousands in the stock market. Mistake 1. Investing without understanding the business. One of the most common mistakes beginners make is buying stocks without understanding the company behind them. Many new investors simply hear that a stock is doing well or trending online, and they rush to buy it. But investing without understanding the business is extremely risky. Legendary investor Warren Buffett once said, "Never invest in a business you cannot understand." This advice sounds simple, but it is incredibly powerful. If you don't understand how a company makes money, how can you judge whether it is a good investment? For example, imagine buying shares in a company without knowing its products, its customers, or its competitors. You are essentially guessing, not investing. Smart investors take time to learn about a company before buying its stock. They ask questions like, how does the company make money? Is the business growing? Does it have strong leadership? Understanding the business behind a stock is the first step towards smarter investing. Mistake 2. Following hype instead of research. The second mistake beginners make is chasing hype. Sometimes a stock becomes extremely popular online. Social media, news headlines, and forums may all start talking about it. When this happens, many beginners assume the stock must be a great investment. But popularity does not always mean value. Investment pioneer Benjamin Graham warned investors about this decades ago. He famously said, "The investor's chief problem, and even his worst enemy, is likely to be himself." In other words, our emotions and excitement can lead us into bad decisions. A famous example of hype occurred when shares of GameStop suddenly skyrocketed after intense online attention. Many people rushed to buy the stock at extremely high prices, only to see the price fall later. This is why experienced investors rely on research, not hype, before buying any stock. Take time to understand its fundamentals rather than following the crowd. Mistake 3. Trying to get rich quickly. The third major mistake beginners make is expecting instant profit. The stock market is not a lottery ticket. Real investing usually takes time. One of the most successful mutual fund managers, Peter Lynch, once said, "The key to making money in stocks is not to get scared out of them." This quote highlights an important truth. Patience is essential. Many beginners buy a stock expecting it to double in a few weeks. When that doesn't happen, they become frustrated or start jumping between different stocks. But long-term investors understand the power of time. When you hold strong companies for many years, your investments can grow through something called compounding, where gains generate even more gains. The most successful investors focus on long-term growth rather than quick profits. Mistake 4. Not diversifying investments. The fourth mistake beginners make is putting all their money into one stock. At first, this might seem exciting. If that stock rises dramatically, the profits could be huge. But if that company struggles, the losses can also be devastating. Diversification simply means spreading your investments across multiple companies and industries. Many experienced investors hold shares in companies such as Apple Incorporated, Microsoft, Amazon. By investing in different companies, investors reduce the risk of a single failure destroying their portfolio. The founder of index investing, John C. Bogle, strongly advocated diversification. His philosophy was simple: never rely on a single company to determine your financial future. Diversification helps investors survive the ups and downs of the market. Mistake 5. Letting emotions control investment decisions. The fifth mistake beginners make is investing emotionally. The stock market constantly moves up and down. Prices rise, fall, and sometimes change dramatically in a single day. When prices fall, beginners often panic and sell their investments. When prices rise quickly, they may rush to buy out of fear of missing out. But emotional decisions often lead to poor results. As Warren Buffett famously advised, "Be fearful when others are greedy, and greedy when others are fearful." This quote means successful investors think differently from the crowd. Instead of reacting emotionally, experienced investors stay calm, follow their strategy, and focus on long-term goals. Learning to control emotions is one of the most valuable skills an investor can develop. Avoid these 5 mistakes, think long-term, and you'll already be ahead of most beginner investors. If you want simple lessons that help you invest smarter, subscribe to this channel and start building your financial future today.